In today's video, we cover the stock, crypto, and commodities markets with a deep dive into what exactly is going on right now. The market hit our range and has rejected it as we expected. Facebook earnings seem to be the catalyst, but there's more at play than just that. On top of this, we have the dreaded hanging man pattern. The question is, where's it going next? And we'll be looking at it together right now. Stay tuned. This is sure to be a good one. All right, well, welcome back to our market recap here for the close of the 2nd of February, 2022. And when we take a look at it on the surface, we know here the Facebook earnings, $200 billion in market value, has just been erased after the earnings report. Facebook dropped a considerable amount, and it wasn't just Facebook. We saw Spot also performing terribly. We saw Snap falling off. We saw Pinterest falling heavily. So all of these social media platforms, everything really in that growth sector was getting obliterated after hours. And that's led to a substantial drop in the Nasdaq already, but right at the same point that we thought the S&P 500 Nasdaq were going to have these resistances. If you're interested in finding out more stuff about this type of thing, remember to subscribe and smash that like button if you do enjoy our content. So here's the heat map of the S&P 500 large companies. And as we knew, when they announced a split, people go ballistic. Google went up 7.52%. It was up 10% at one stage, and that was the shining light on the day. PayPal missed earnings, Netflix sold off after having a big rally, and Tesla considered to battle with this key zone, and we'll look at that on the technical side a little bit later. But the story really wasn't here. It wasn't in necessarily the session itself. It was the after hours that triggered this sell-off, and this is where we're going to find the battle of the bulls and the bears in the next couple of hours, as in we're going to see it play out over the next 24 hours. This is the market for the day. Now, something different happened here. We did see a market that was holding its own. It obviously still was closing up 0.94% here on the SPX, but notice that's pretty much where it opened from the futures, and it wasn't significant purchasing into the close of the day. If anything, it was stagnation. And this is the first day that we've seen Wall Street stop and not purchase the close. Remember, what happens at the close is way more key than what happens at the open from the general sentiment of a swing-based trader, investor, anything like that. We want to know what Wall Street's doing. They're over here. Retail's over here, so we need to follow that. Small cap companies considered a pretty bad day for them. They underperformed, and that's important for us to look at as well, because small caps and basically the health of the broader market, they're not looking so good. And IWM, the Russell 2000, shows us that. Let's have a look at the sectors. Were there any other clues? Yes, the first day of defensives coming through. Utilities, healthcare, consumer staples, financials. Some of the best sectors for the session were the defensive sectors, and these were the first times that we've seen these actually come up heavily and start to outperform. It again shows that Wall Street may have just set a trap for retail, and they might be getting ready for a little bit of a dip here, which we suspected may occur. We'll look at the key zones to be watching. Another big reason why maybe the market might drop but not necessarily crash just yet is the puts. So remember, retail traders opened up puts at a 38% higher rate than March 20. So this is literally the pandemic, and this was an incredible opening of puts over the last couple of weeks. Small traders as well were a big part of this. And we know Wall Street likes to prey on our human emotions. And one of the big things we try to do on the channel is to show how these things happen, how the market dynamics work, and for you to better understand some of these things in both the crypto, stock, and of course, commodities markets. Open interest per over the week. Let's just quickly look here at the open interest of the options. And you'll notice we started the open here. We had the 420 strike and we had the 460 strike. So both of these strikes were the two key resistance and support lines for the week. It's a big range. We understand that, but there's some points that if we reach them through the week, we like to use these option strikes to show us key resistance or support. Then the next day, we see a lot of puts continuing to be opened, but also an increase in the amount of calls opened through the session with a bit of a smattering in between, kind of gives us that big range. But something happened over the last day of trade. We saw a significant level of calls being opened and really the trap being set. A huge amount of open interest coming into 460 and just above that And it's really one of those points where everyone started feeling euphoria. We saw it in the comments. Everyone was really bullish. We're still bullish medium long term on the market, of course, but these are the day-to-day things that happen in trading. So it's interesting to see it, and you can see it play out over the week through those options. Let's talk about a couple of stats so we can figure out what we think is coming over the next month, just from a data perspective. So when you have huge rallies, such as we had 2-day rallies near the end of the month, if you look at the stats over time, only 30% of the markets were positive for the next month. And that doesn't mean new lows, but it certainly means some instability and up, down, and all the way around trading action. In fact, most of them were negative, and you can see it here in terms of the average and median negative 3.1 and 4.6%. But there's another stat here, and that is that if you have a down January, it tends to spill over into February. Again, stats are 33% that we have a positive month. We end up having usually a negative month, and it's very sideways. And it all falls down to this idea that February is a little weaker. And that's one of those things where if you look at the technology sector, the growth stocks, they tend to have that weakness, maybe Jan, Feb, March. But guess what? You've got to be prepared for the bull rally, because when they come through, the rallies can be quite extreme. So technical analysis along with the data can be quite effective. If you want to find out more about some of the things we do in terms of options and stuff, come and follow us over on Twitter. We do share some of this information over there, so you can just follow at FX Evolution on Twitter. So we mentioned the big earnings. Yes, we've had Meta. It was a disappointment. Spotify, a disappointment. Now we come down to some of the other big ones. Snap kind of going early here in terms of sell-off, same with pins, but Amazon will be the big linchpin to what the market wants to do. A lot of people are negative on sentiment on this stock, and we'll have to find out what it brings. We can't be soothsayers in terms of understanding exactly what Amazon's doing. If you're going to ask me what I think is going to happen to Amazon over the next 3-4 years, I've of course say bullish. But in terms of this next earnings announcement, and more importantly, the guidance, because remember, this earnings is all about guidance more than anything else. We don't know what's going to happen, but we do know that the stock markets are starting to show a little bit of turn in them, and we'll go through that right now. So we'll begin with the VIX. The VIX came down to the 20. It then started spiking up. We know that when the VIX is above 20, high volatility, more likely to see bearish, large volatility action. That is what we are currently seeing in this market after hours. The other thing is that the 2-year yield, surprisingly, is actually dropping at the same time. So this is something that we want to see occur for us to be able to have that sustained bull run. We kind of need the Fed and the 2-year to meet in the middle. Let's say a harmonious meeting. The Fed's kind of here, the market's kind of here. We need them to, come together and say, okay, this is the level. We need the market to cool down here for the markets to make all-time highs. That's one of the things that I think is one of our prerequisites in our kind of 4 or 5 reasons when we believe the market will really turn around and show that sustainable growth. Gold was improving. Some people see this as a hedge of the market. It's not always proven to be correct, but we had that little inverse head and shoulders that we've been talking about. So far, if you'd traded that position, I guess you're up, which is good. It is showing signs of still strength, but you've got to be careful in the manipulated gold and silver assets right now. Something like US oil has been much easier, but even that is starting to struggle. Look at these candles. Look at what the market's telling us. The story's not that great. We've got rejection candles. Then you've got bullish buying, kind of long leg doji indecisions. And then we've got long leg doji, buying candle, new peak, long leg doji. So much indecision on the oil trade. I think this market, while maybe not necessarily peaking, isn't interesting us from a day trading perspective. If you're in it for the longer term, totally get why, but it's not showing those incredible gains and incredible great technicals that we've seen leading up to 85. This entire 85 to 92 run, which is where we expected it to go, is still looking shaky, and you can tell that in the charts. Let's move over to stocks before we cover indices and crypto. And it's, Tesla, as we kind of suspected, weakening here, and a lot of that's got to do with the options market as well. A lot of 950 call strikes, a lot of 1000 call strikes sitting there. If you scroll down through as well the time frames, you'll notice here the 4-hour 20 exponential moving average, this red line, continues to be a bit of a problem for Tesla. It's sold off once, sold off twice, and as we reported throughout this week, this was our real resistance for the stock. And while we loved it on the Monday trade, we thought there was going to be some profit taking around this zone. There has been so far, and until it gets back above this area, above this 950, 960, gets through that option strike, then it can rally to 1,000. It just doesn't quite look like it. Some people are probably going to say, what about inverse head and shoulders? Yeah, this could certainly be, your right shoulder, your left shoulder, and your head. But guess what? It hasn't gone through the neckline yet. So we just might remain bullish on it. But at the same time, the market's not saying strong buy, strong buy, strong buy from a pure day trading perspective. We also reported on ARK, this one here, a bit of a hanging man candle. And you'll notice this is across so many of these indices and so many sectors and so many things. A big warning sign that the market might not be as healthy as we believe. We've got this 20 exponential moving average. We know that's the big signal here, along with the trend line for recovery through hyperstocks. In many ways, ARK-K can be seen as a hyperstock kind of indicator. And in this case, it hit the 20 and sold off immediately. It might go lower. It may go to the low. We don't know yet, but there's no real trade on this unless you're bearish on this particular type of index or type of sector, because at this stage most signs are going bearish, and where the bullish action comes back in is after you get past these levels. So we'll continue to watch ARK-K, as we do believe that hyperstocks at the right time will provide one of the best opportunities of 2022. It just kind of makes sense based on how much they're hated. They're down 70-80%, some of these, and they will turn around. They are a good investment if you find the correct stocks at the correct levels. Not everyone is great. Let's move over to the Nasdaq before we do the S&P 500. And here is one of the interesting ones, the hanging man candle. Now, for these types of things to confirm, you generally want a bearish reversal, a bearish candle on the next session, and you need that to kind of hold up. But this is one of those early signs, and it's happening exactly in our zone. Again, the S&P 500 almost to the point hit our level. And it's starting to say, well, maybe this run was a little bit too fast and it's time to take the cooler pedals off. Maybe pull it back to where it was on the Monday session. It makes sense. Big rally, pullback. How many times have we seen these rallies kind of occur where everyone gets euphoric? You've probably been stuck in one and accidentally bought it before, where you see a sell-off, a rally, you get involved in this thinking, oh, that was as big as it was, then it sells off again. Or it buys up, and then it has some kind of secondary kind of dip or secondary movement down. It's the nature of markets. It's what they do. So at this stage, if you're looking at the Nasdaq and you're thinking, oh, I'm pretty excited to be getting into it, all of those types of things, you'd have to think that at least it tries to test these previous resistance levels around this 14.5 to 14.6 level. And that's where you look for that lightning bolt up, that sign that the market has said, okay, cool, we're cooling, and now we're ready to move to the next level. Or if it breaks below that, guess what? Could be coming all the way back down to the 14,000 or even lower. Yes, it's very possible. And one of the reasons why it's very possible is this chart. I like to look at the Russell 2000 or the smaller cap companies as a bit of an indicator of health of the economy or health of overall all the businesses. We're not just talking about Apple and Facebook and Google and Microsoft and how great they all are, though Facebook not today, but in general, great businesses. This is a Wyckoff distribution. We have the false breakout. Obviously, we did report on this one last year. We thought it could be real. It turned out that it broke back down. And then now we've broken underneath a key support that was a year in the making. It's a big deal. And when the market comes back up here, what do we expect to happen around this point? This is one of the reasons why we thought the rally might not be able to sustain fully. This previous support, you would think, is going to act as resistance. And until you get through this, you can't really be saying, oh, yes, everything's great, the market's fantastic. This is the lifeblood of the market. It's the small cap companies. You may disagree with me completely, fair enough. But I think a lot of us together have kind of come to this conclusion, and you should, that the market is really a different kind of thing. When people are scared, they run into what? Big blue chip, large companies. When people are feeling, really great. They jump into some of those risky bonds, they jump into small cap companies, they start to speculate. So this market's not showing us that extreme speculation, and it is down more after hours. So I think that's one of the things that's pretty important here. Some other signs were daily 20 moving average, obviously coming up to that, but this remains still a big problem area regardless of when you're looking at these charts, and whether you follow this channel or not, it should be something that you have on your charts and you're aware of. US 500 from the futures market, it kind of looks like it rejected in our green zone. I haven't moved these boxes. They're the same we've been looking at. The reason we even got this box was purely technically based. I mean, all we did was we took the distance from the actual base formation that formed over here. When it broke out, we got that distance, and then we speculated that it would somewhere stop below that 45.50 to 46, and that would be where we see the turnaround story. Now, after hours, you can see it's down a little bit. If we go into something like a 15-minute chart, what you'll notice is that the market kind of sold off a little, rallied back up, made a new peak, and now it's putting pressure on this downside. And when the real market opens, the real volume, that will be the tester for it, because this is where that market is. Remember, the Nasdaq has a hanging man candle on it. If it closes bearish, that could be further signal that we're going even lower at that point, because of course that's a bearish signal in the market from a technical analysis perspective. But regardless, it's going to be an interesting day trade through the Thursday session, because it's going to be volatile. There'll be a lot of kind of tricks of the trade, and you notice here, look at the buying. All of a sudden it rallies up here, let's say that 45.60. Do we see selling reoccur here? Is that where it starts to push down for the session? Amazon misses, all of a sudden it goes through. Jobs number Friday, big deal. Will that disappoint the markets? You can tell that it's starting to get a little bit shaky at this level, and the same goes for the SPY. I mean, it's right at that zone again, that 460, just before it stops. I think it got to 470, 458.12 for the session. Let's now move over to Bitcoin, talk about that. Well, Bitcoin remains the exact same signal as it's always been. Downward trend, pretty terrible in terms of the downward trend. 20 moving average as well, this red line here. Some people are calling this a flag for a whole big new sell-off. If you're calling it a flag, you probably should be taking the distance of the pole length, working out that distance and extrapolating that out. And that will get you back into a new all-time low. Well, new, not all-time low, but low from the rally. I'm not sure I'm convinced of that at this point, but if you're looking at this chart, look, it doesn't really look bullish until you move past the 20 moving average, until you snap this last high off and this downward trend line, because those signals alone will actually say, okay, cool, this shorting that's been happening here for realistically months now is finally over, and Bitcoin is down 50%. You know, this particular coin is the lifeblood of the crypto market, whether you like it or not. It's a big indicator. It's like the index, and just as much Ethereum is also one of the indices or index. And when we look at this, you'll notice we have the resistances becoming support. It's pretty critical that crypto holds here. This one looks a lot better than Bitcoin. Maybe it's a little bit of Ethereum loving. People will be buying it. There's a lot of stories about scarcity of Ethereum due to burn rate and stuff like that that might be causing it. So look for little double bottoms here and a breach of this high. If you're a day trader, there are going to be some key technical levels. More importantly, we're not really seeing BTC shorts coming up, which means the whales aren't exactly shorting the market at this stage. It's just maybe moving a little bit more with the Nasdaq and with, of course, the other indices, and kind of the pain and the suffering that they're being forced to have is flowing over into the crypto markets. As we mentioned before, it's all about these big, key, important bits of news. And on Thursday, we have the PMI data, 10 a.m. for the US, and this will be 10 a.m. New York time. And then we have the big one Friday, 8:30 a.m. we have the non-farm employment change. So if you're not sure about what that is, I'm not sure if it's a good time to be really scalping into that. You probably need to be set and ready. But yes, non-farm employment change, the unemployment numbers are coming out for the US, or the jobs numbers, and we'll find out whether this market wants to hold up or whether this market wants to sell off a little bit. Thanks so much for joining us today. If you enjoyed the video, please remember to subscribe, smash that like button, and put down in the comments below, what do you think Amazon's going to do? Is it going to beat or is it going to miss?